So for longevity, yeah, growth is good, but you also have to watch out that because growth will also, I mean, how many companies had growth? We don't hear the stories of people, you had growth, you issue more equity, you issue this. Before you knew it, you have no say in your company anymore. So, I've dealt with companies over the years, and then you talk to the founder and he's like, hey, what happened here? I don't have a say anymore.
They own like 10% of it.
Correct. Like you just gave away for that growth. You gave away your freedom.
All right. Welcome back to Expandable. You got a letter this morning, or you picked one up from a client or something.
Yeah.
Tell us about that.
A long-time customer. So, our longest standing customer. I know he's been customers since the 60s, and family members have been shareholders. Surety Building Loan. So, he'd found in either his old records or family members' old records, 1970s, it was notice of stockholder meetings, Surety Building Loan. And in 1970, it was like, we're paying our usual 3% dividends. And it was kind of awesome because that has just kind of kept on. So, and at that time, it was like $5.5 million in assets in 1970.
Yeah.
So, Surety Building Loan has always been on the small sides, whether building a loan, a bank throughout the years.
Yeah.
But from the beginning, the earnings that the bank has paid in dividends to the shareholders over the 100 years, it's
amazing.
If I had the records for the 100 years, it would really destroy, the earnings on all the Fortune 400 companies. Really well. It paid out. What is really cool is it didn't just keep it in. Like every year after year, earnings went out to shareholders. So it,
that translates to every other business.
It created their lives. Imagine the leg up. You've got an asset that is earning you, and now you've got your day job. So, that's what gets you ahead. That's what you need is stable businesses that you've invested in that are providing you earnings to get you
that's true wealth
and build and build and build.
That can build
that is really cool. It doesn't have to be, the most well-known business in the world, but there's a ton of businesses out there that have been around for a while and have paid good earnings and have, and thinking about everybody who's employed during that time.
Yeah.
Not one time in 100 years did they fire people because of the economy.
Right. It's amazing. And so I've been thinking about this conversation.
Quite 198 years now.
Perfect dovetail is balancing profit, being profitable with growth. And I think this is the perfect kind of segue because it proves that over all these years, decades and decades, that Surety has been paying out to their shareholders dividends. They've been prioritizing profit. And that's amazing because a lot of companies, especially today, like let's fast forward to 2020, 2024, era where you have the tech billionaire, status where they're like, everything's a unicorn, everything's worth, $3 billion. And it's just not. And they're prioritizing growth over profit. When what are you getting into business for at the bottom line anyways? It's to make a profit.
I know. And look at the statistics of how many of those actually succeeded. And whose money did you burn along the way?
Yeah. It's like investors have this shiny object in front of them of the Mark Zuckerbergs of the world. Yeah. However few there are, and they're all trying to rise to that challenge.
But those two also kind of showed that they actually had a place and that they were going to be used before they, like they had proving themselves in the market. They were proving themselves in the market too, in that growth. You know, it's other like you could tell those unicorns. They had more to it than somebody, than a lot of the fintechs I've seen here. We got to grow. But like they know they're profitable. Yeah. And that growth. You can see that they will be. So many other things, it's like, wait a second. If you look at your per customer cost, you're never profitable. So what is your growth really great?
Right. Now, when you start out, depending on the type of business you're in, you might not be profitable for 3 years, 5 years. There's a short period of time which feels like forever.
Also truly
but that's getting
paper,
started.
But that is paper as of, yes, you have not covered your monthly expenses yet, but you can see and should know as you're selling your product and as you're selling your service, you're not losing money every new product and every new service you sell. That you're whittling away at your base expenses
it's
to
not,
get to that profit.
Not every sale is a loss leader, as they call it. You're actually you're starting to make even a small margin, and you're figuring out your expenses in your accounting, and you're figuring out your efficiencies and your systems and all that. And it doesn't usually take you long to be profitable if it's good product market fit.
Yeah.
Everything's in line.
I mean, yeah. And then that new employee you hired, they're not going to perform and cover their cost immediately. Mm-hmm. I mean, you know that.
Sure.
But I mean, you should also know what given time
what time.
Yeah.
Yeah. I just think this is kind of special that you got this letter, because it's just like harkens back to the old days where most businesses thought in terms of profit first versus growth first.
Well, yeah, because they always thought, oh, it's greed. No, profit, you're not going to have continual profit if you're not taking care of your customers. So that's
right.
Right. They're one and the same. Mm-hmm. I mean, you have to take care of it, but that also
that's an interesting point.
Leads to stability. You have to have stability. You have to be there for those times and to be in a good place when opportunities happening that are very low risk.
Yeah. Yeah. Growing in a stable manner, incrementally, is, I think, very prudent way to grow a business because it's sustainable, and you are taking in the feedback from your customers, and you're applying that feedback.
Yeah.
And you are talking to your shareholders and applying that feedback. And that type of growth is very different than, I think that's less greedy than a less greedy kind of philosophy than we need to add, X million dollars in revenue this year and X million dollars next year and so on and so forth. To me, I see that's a striving for, some ubiquitous number that's out there.
And in the bank world, when they're growing, let's say they're already established, they're not in the first few years. And because in the bank world, when you're a startup, the engine is getting loans on the books. Mm-hmm. And as you've got loans on the books, you've got that recurring revenue to cover your base expenses. Yep. But if you've already got an established bank, they've been in 10 years, and then they have growth, and you're like, oh, your earnings plummeted 50% for growth. It's kind of like, wait a second. Each time you grew in more loans, you should have started to make more money.
That's right.
It shouldn't be covering your costs.
Yeah.
Because
if you're writing the right loans, if you're writing good loans,
correct,
for the customer and for you,
and typically where they're in that growth stage, defaults are usually not an issue.
Yeah,
but it's amazing. Oh, we didn't have any. And when I hear on the bank side, we didn't have our earnings because of growth side. You put on performing assets. You should have had growth. So what how much did you spend to get that?
Yeah.
So I mean,
so talking to the average business owner, and you talk to them all the time, what kind of I don't know, how would you share your mentality? Because I think you have, I don't know if it's DNA or if it's it's just how you operate. You've picked up this wisdom over time, but I mean, you really do have that natural tendency to prioritize profit and prioritize being efficient, in light of profit. So how would you extend that thinking to your average business owner? What would you say to them to adopt that?
Well, I had to change mine years ago. So, I started in banking, but I've never had a banking mentor that knew banking. I just had to get in and then started reading, watching what we did here at Surety Bank, and then started reading rules and regulations and had good tutelage on the commercial lending side.
You had to learn the business of banking.
Correct. Commercial lending side and ask questions. So I didn't know how everyone else asked, but I knew in banking, if you want to be a bank, you've got to have a license.
Yeah.
And who gives this license? And so state, they're going to audit you, and you need insurance, and FDIC is going to insure you. So there are a ton of things that you have to do.
Yeah.
On compliance. And you can sit there whining about it all day long, but for the most part, a good majority of them in the compliances were put in position because something bad happened.
Yeah.
So learn that, and there are ways to build in efficiencies. The work that you have to do that you're frustrated with, I think there are ways it learns. that you can
make it more efficient. Yeah.
Correct.
Yeah.
And utilize. So go with that angle.
Yeah.
Not just someone add it. Well, if I have to do it, what other benefit do I get? Whatever
Right.
Whatever
that,
benefit insight do I get on
Yes.
that? So for loans in itself, earlier on, when I started coming along and started seeing examinations and what they were looking at, it was always like concentration risk. And it's like, well, what is concentration risk? And that's just basically not having all your eggs in your basket. So when you're lending, it's okay. They look at concentration as commercial. You got residential. Commercial can be a residential house. It's just the purpose of why they borrowed it. You know, if you have an investor that has 10 residential houses, that's commercial.
Yeah, right.
Because they're growing profit. But if you have, Lee, I want to buy a house that this is my primary living.
Yeah, it's different.
Residential. So there's one concentration, but then there's concentration when that, and so it gets prudent. If part of the economy is going to go down, sometimes parts of the economy, business sectors, will go down first. And others will come later. So it's just kind of spreading around. So that's kind of a good thing.
Yeah.
So know your concentrations. And when you do have a lot in a certain sector, that correlates to everything else within your business of concentration risk.
Yeah.
And so you can just continue on those applications and, some of it makes sense. So then some of it helps you run a better business.
Right.
And you can look at it that way. And other things, don't make any sense. It was law put into place 40 years ago, but you better know it and you better follow it. And just is not relevant today. And at some point, maybe it'll get changed. But those,
Well, so, every business owner gets pulled in so many different directions.
Yeah.
How do you show up every day and give your time and attention to being profitable when and maybe not today, but like over the course of your career, you've had different seasons where, you're a little bit more profitable than others, or, revenue has been a little bit less than others in different sectors, as you were talking about. So how do as a CEO, as the one driving the ship, how do you divide your time to be able to focus both on growth and profit? Because I think a lot of times you end up getting, I think owners get pulled into growth because they're trying to either, pay bad debts or bad sins that they've had over here.
Yeah.
Or they get pulled into profit and then it slows on the front end.
Yeah. The areas that, and some areas can naturally have growth that you didn't expect. And then you've got to then, pay attention to it and, okay, is there a risk here? Why did it grow?
Yeah.
But, circle back to that. You had a bunch of your original question was, how am I paying attention to what area of growth and what they're going? The area of growth has to have the most efficiencies, scalability, and lockdown. So when I see areas of growth, a lot of times too, from the banking, that's risk as far as now you got
to manage that risk moving forward.
Correct.
Okay.
So Nat thought, do we have things in place to do it? Because in our world, I can't let growth get a hold of you, because then now you're beholden and you can miss a compliance.
So that kind of naturally drives profitability for you too, because
and then you stop
there's
like
a little bit
on that growth. So we're beholden to, when you have a company and you have board of directors and you have meetings, that then is going to restrict a little bit of growth as far as, a single operator business. Okay, they can make decisions right then and there.
Sure.
But having that structure also gives you a little bit, calculated. You don't have to do everything that exact second.
You get support and you get, advice, and depending on who's on your board, you have, various different components to that.
Yes. So that goes in. But, those areas of growth, as it's starting, you have to really stop at intervals and see how well that's performing. And in the banking, you can't let that growth get away from you, because the banks that are in trouble right now, they have basically, the regulators will call rent a charter, or you have the de novo banks. But essentially what they did is, instead of having a bunch of individual customers, they would have one customer that brought a bunch of customers that they don't know.
Yeah.
And so in essence, you gave away a little bit of your marketing. So you've got somebody else growing, and this case, say that maybe they're growing a new checking account because there's a quick user interface and they're quick and give you payday loans a day earlier. So you're basically outsourcing. You're outsourcing. And to me, all of that has risk. With the bank, is that cost? Are you growing this? But if that grows too much and out of your control, you basically just gave someone else the keys to your license.
Yeah, basically. Yeah.
Or
if it goes away due to regulation or it blows up, whatever, now you have a big crater in your business that's happened. Or if not, maybe take you down.
Yes. So for longevity, growth is good, but you also have to watch out that because growth will also, how many companies had growth? We don't hear the stories of people, you had growth, you issue more equity, you issue this. Before you knew it, you have no say in your company anymore.
Yeah. Yeah. You've lost it.
You know that, So, I've dealt with companies over the years and then you talk to the founder and he's like, hey, what happened here? I don't have a say anymore.
Yeah. And get pushed and pushed.
Great.
Now
Now
like 10% of it.
Correct. Like you just gave away for that growth. You gave away your freedom.
And there's a pretty clear correlation there. It's pretty stark. Like the more I would call prudent business owners that I don't want to talk bad about the people who grow.
No, they're fantastic ones.
But it's for whoever, right? But there are people who grow and they get 10% of $1 billion company, and that's great. But then you have the other ones that maybe build and hold or build and sell, and they have 100% or 90% of a smaller number that's more manageable, and they're able to sleep at night and. All their risks are relatively mitigated or managed, and their team is well taken care of, and there's a good place to work, and all these things are happening. To me, just the way I'm wired, that is a much more inviting way to do business because there are so many unknowns that come with growth for the sake of growth. Like we talked about, the risks that you don't even know you have until they happen, and then they're unmitigatable. They could blow your whole business up.
Yeah.
To me, the stress level here is still stress of owning and running a business, much less than here.
Yeah.
And
I just think as you grow, you just want to make sure you have control in the banking world that you're in charge. The bank is in charge because it is happening through our license. We have a duty to not only our shareholders, but we have a duty to every customer out there to keep a safe banking system.
Yeah, right.
So we've got a little bit, on that, but
you have layers that you have to account for or account to people and entities before just running your business like a normal person would run a business. So you have these sort of built-in mechanisms that force you to look at risk. And then as I'm following you, your risk then goes to efficiencies because you want to have systems. And going back to that, like it seems like whenever you find an area that's growing, you want to mitigate the risk, put systems in place, one for the regulatory side, but also so that it can scale properly.
Correct.
Right?
And those systems in place, even inadvertently, let's say it's, those are triggers too. If the people you are customers with and they can't follow the compliance guidelines, then, that's a trigger for you that could be a bad apple in the bunch for whatever reason.
Right. All right. This is good. I think there's more to explore here, so we'll have to come back to this another time, but this is a good start. I think it's super valuable for business owners to hear like your mentality. Cause I think this is very much in your DNA, your thinking. It's a natural thing. It's not something that you had to adopt. And I think that a lot of people need to adopt more of this mentality versus, hey, we're making a lot of money on this thing. Let's go.
And I like to see things build on. Like you do things once. I hate the repetitive tasks. And you and I have seen people over the years that have done so well, but it's kind of like you're gonna burn out. You're gonna work 50 hours a week doing that and having to continue to replace clients and
a system of revenue versus always starting over. Next month.
Yeah. And I'm not looking for, not you. I want to be able to build and build and build on.
Yes.
Not, okay, great. I just, sold that. I got 3 times my annual salary, payday. Now I'm going to
start over.
What's
that worth? I mean, for different people, different situations, but by and large.
Okay, great. That's a one time. And that's kind of like in the banking world with when banks sell, I mean, that's kind of like the ubiquitous is why, because a lot of the executives are going to get 2 to 3 times their annual salary.
Right.
Because
they don't have built to do the ability to do that outside of that role.
To me, I just want to, why not everybody's earnings continually increase as a year? And so instead of 2 to 3 years, now you're in 10 to 12.
Yeah.
That is there and sustaining.
And if you apply that mentality to your personal management of those finances, right, from the business side, then you're winning.
Yes.
Love it.
All right.
On to the next one.